Hello everyone, my name is Tyler Miller, and I'm a wealth manager, CPA, certified financial planner, and certified investment management analyst at Raymond Gurrell Wealth Management. Today we'll be covering one of the most lucrative tax strategies within the Google 401k plan, the Mega Backdoor Roth. This strategy gives Google employees a way to turbocharge tax advantage savings beyond normal IRS limits in their 401k plan. If you or someone you know could benefit from this strategy or the other services our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Without further ado, let's jump into today's topic, the Mega Backdoor Roth. So, what is the Mega Roth? At its core, the Mega Roth is a tax strategy embedded within the Google 401k plan. By undertaking a series of transactions, employees can make contributions beyond normal IRS limits. In 2026, employees can contribute $24,500, either as pre-tax or Roth contributions, with an additional $8,000 catch-up contribution if they will be 50 or older by the end of the year. The Mega Roth allows certain employees to add tens of thousands of additional dollars beyond this to the plan annually. To fully understand the benefits of this strategy, let's review how pre-tax versus Roth contributions work for tax purposes. To reiterate, for 2026, employees can contribute $24,500 to the pre-tax or the Roth account, or a combination of both. Pre-tax contributions are made before taxes are paid, which reduces taxable income. However, all contributions and growth are taxed upon withdrawal in retirement. Roth contributions, on the other hand, are made after federal income taxes are paid, meaning both the original contributions and all future growth are tax-free upon distribution. The decision to contribute to a pre-tax versus Roth account depends entirely on an employee's current tax rate versus their anticipated future tax rate. Concurrently with your pre-tax or Roth contributions, Google makes a matching contribution, matching 50% of your contributions up to the IRS deferral limit, for a maximum match of $12,250 in 2026. Based on the contribution limits discussed earlier, the total amount going into the 401k for an individual maximizing their pre-tax contributions is $36,750, including both employee and employer contributions. This $36,750 total is still below the IRS maximum contribution limit for all sources of contributions, which is $72,000 for those under the age of 50 and $80,000 for those 50 and older. So where can this $35,250 difference between the IRS limit and the other contributions go? You guessed it, the after-tax account. Let's discuss the tax features of the after-tax account, as it is a blend of the characteristics of both the pre-tax and the Roth accounts. After-tax contributions, as the name implies, are made after federal taxes have been paid. However, any growth that occurs while funds are in the after-tax account is taxed as ordinary income upon distribution. So you might ask yourself, why contribute to an account that does not provide an immediate tax deduction, while the growth is eventually taxed as ordinary income? Because we don't leave the funds in the after-tax account to grow indefinitely. The Google 401k plan allows participants to convert these after-tax funds to Roth directly within the plan. And the best part? If funds are converted to Roth before any growth occurs, the conversion is entirely tax-free. Here's how it works. Once the pre-tax or Roth contribution limits are reached, the employee can defer additional funds into a third account within the plan, the after-tax account. These additional funds are then converted into the Roth account, where they can grow tax-free until they are distributed in retirement. At this point, it should be clear that this strategy can be a major tax advantage for retirement savers. It's also important to note that most 401k plans outside of Google do not offer this strategy. Among all eligible 401k plans in the US, only about 30% provide access to the Mega Backdoor Roth. To better illustrate the tax benefits of this strategy, we'll compare an individual who fully utilizes the Mega Backdoor Roth strategy over their career versus diverting the same after-tax funds into a taxable brokerage account. Using the same numbers from the previous example, let's say this employee contributes $35,250 per year for 20 years to a brokerage account. Assuming an 8% growth rate, these contributions will grow to roughly $1.61 million over the 20-year period. This means that within the taxable brokerage account, there will have been $705,000 of contributions and roughly $905,000 of growth. Assuming a 15% long-term capital gains rate, this will result in over $135,000 of taxes paid when the assets are sold. If instead, this employee utilized the Mega Roth strategy over the same 20-year timeframe, all of the dollars could be distributed in a tax-free manner, resulting in over $100,000 in tax savings. Before wrapping up today's discussion, I want to highlight a few key considerations surrounding the Mega Backdoor Roth. If you have a pre-existing after-tax balance within the Google 401k or growth on recent contributions, you need to be aware of the Pro Rata Rule. This rule states that if an after-tax account contains both contributions and taxable earnings, any conversion or distribution will be partially taxable based on the proportion of contributions and earnings in the account. Since these numbers vary for each individual, we highly recommend consulting with tax professionals, such as our in-house CPA team, to understand the tax implications of any future conversions. Because the Google plan allows you to convert your after-tax funds to Roth directly within the plan, these conversions can be handled inside the 401k itself. Given the complexity of these transactions, having a tax specialist on your side is critical when making conversion decisions. Thank you for taking the time to learn about the Mega Backdoor Roth strategy. At Raymond Gurrell Wealth Management, we have over $1 billion in assets under management. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.